Hello and welcome to CNBC TV18. You're watching Restarting India and I'm Shireen Bhan. The festive season has brought with it some cheer, at least for a large part of the formal economy. Most automakers are reporting a surge in Navratri sales. It's a 100% increase for Tata Motors compared to last year, while Hyundai and Kia Motors tell CNBC TV18 that they're having a hard time keeping up with demand. Even luxury automaker Mercedes-Benz has reported record sales this season. Industrial and commercial activity also seems to be gathering pace. India's power consumption grew 11.45% in the first half of October compared to the same period last year. That is the first double-digit increase in that number since March of this year. That's not all. Earnings from freight rose 11% versus last year and loading was up 18%. The good news is that all of this data is coinciding with a reduction in COVID-19 cases in the country. Active cases have seen their biggest single-day drop today and the recovery rate is now closer to 91%. Speaking at the India Energy Forum at the CERAWeek, the Finance Minister continues to sound an optimistic note. She says that we are seeing a steady and sustainable recovery as PMI data begins to look up, festive demand increases and FDI inflows show a steady increase. Let's hear out those comments.
We have a contraction which happened during the first quarter, and post which the unlocking has been steadily happening. And we can see the revival now, particularly in the PMI, which is the index which all of us are talking about, which shows a spurt in the number, the highest after 2012, which itself sort of indicates that the revival is there, which is going to be steady and sustainable revival. If that sustainable revival is going to happen between Q3 and Q4, we expect that the overall GDP growth, notwithstanding the pandemic, should be something which, as is being predicted by the IMF, even if it is going to be in the negative or near zero this time, the next year will be very clearly India seeing itself as one of the fastest growing economies. The indicators show that primary sector, related sectors of agriculture and rural India are all doing very well. As a result, the demand for durable goods, agricultural equipment, tractors, vehicles are all going up. And festival season has commenced in India, as a result of which I expect the demand to go up and therefore be sustainable also. Public spending on infrastructure, both by the union government, which is at the center, and also by the various state governments, for which we have very clearly understood that the funds are also going to be coming through the foreign direct investments. So the National Infrastructure Pipeline was announced in December 2019, which listed out about 6,000 projects. We are attracting a lot of funds, to which the spend on infrastructure is the top priority. The second is making sure that agriculture and the related activities such as processing of food, export of agricultural goods, making sure that the connectivity to the nearby ports and also making sure the cold chains are all going to be in place. The FDI flow inwards in India between April and August 2020 grew by about 13% compared to the non-COVID 2019 comparable period. All of them have really been attracted by those companies which have set global standards in their governance practices. So India has a list of such companies which, because of their best practices, are even during COVID able to convince investors, and they've been coming in.
Well, that is the Finance Minister. Joining me now to take this discussion forward, Rashesh Shah, the Chairman and CEO of Edelweiss Group. He's also the former President of FICCI. We also have with us Ajay Sahai, the Director General and CEO of the Federation of Indian Export Organisation. Anil Bhardwaj, the Secretary General of the Federation of Indian Micro and Small Medium Enterprises. Gentlemen, appreciate you joining us here on the program. Rashesh, let me start by asking you, you heard what the Finance Minister has to say. There's also a slew of data that seems to suggest that there is an uptick in the economy, at least as far as large parts of the formal economy is concerned. In fact, there's an interesting comment that has come in from the management of Tata Motors post their earnings today. NBFCs are supporting financing with a vengeance. Rashesh, what do you make of this?
Actually, we have seen a clear uptick, and I think, this started around August. So if you look at April, May, June, July, there was a lot of panic, there was a lot of concern, but we started seeing the uptick in August, mainly out of, the fact that COVID was not as bad as people expected. The fear was much higher than the reality. A lot of government schemes, RBI schemes started coming into play, and the economy started unlocking. So I think August, September and October have been very, very encouraging, and I think liquidity has improved a lot. So, if I look back, I would say April, May, June was more like a crisis, and now we have clearly August onwards made a U-turn. Now, still we should be careful because the resurgence is not across the economy. It is very patchy. Part of this is pent-up demand, and part of this is actually the resurgence of the underlying consumption patterns in the economy. Like rural economy is doing well, but urban is still not as back on track as we want. So I think we need to be careful, but clearly the crisis is over. Now, if at all anything, there is a challenge, the challenge of investment and growth going forward. But I think we have done a good thing. We have at least averted a crisis which was very much in the air around April, May, June.
Okay, so you're saying that the crisis is behind us, but we still have challenging times. And you're right that the recovery that we are seeing is perhaps not as broad-based as one would like. It is patchy and it's playing out differently for different sectors. But let me ask you about the next set of measures. I'm asking you this because the Finance Minister has held out hope that there is a next set of stimulus measures that will be announced. This has now been confirmed by various government officials as well. So what is industry expecting now in terms of the next set of stimulus measures? What should be the target?
I think the best thing the government can do, and actually it has done in the last few months, government has given a lot of liquidity to the rural economy. The 3 lakh crore MSME, the Atmanirbhar Bharat scheme has been a fairly big game changer. The PCG schemes have been good for NBFCs. So I think government has done quite a bit on the liquidity side. Now I think government needs to push on consumption and investment side. On consumption side, I would say the stimulus should be in the form of putting money in the hands of people. Maybe some amount of GST rate cut on consumables and others. I know we all talk about how much space the government has, but I think government has space. This is the year they can expand a fiscal budget a little bit more. So the next round should focus on getting consumption revived strongly, and then eventually how to get investments back on track. And one of the key thing about investments is going to be the long-term ease of doing business, the long-term investment climate that we need to improve.
Yeah.
And strangely on the long-term investment side, equity availability has improved a lot. We're seeing IPOs doing well. A lot of FDI equity has come, but the credit markets are still dislocated. So government should do a set of things to bring credit availability back in the economy, because even today credit is growing at only 3 to 4%, and we cannot really be back to structural growth unless credit growth at least gets to 10-12% per year.
Yes, so credit growth continues to be constrained, the credit market still dislocated, and you believe that the next set of stimulus measures, the government ought to put money into the hands of the consumers. Whether that is going to be part of the plan, we don't know. But let me go across to Ajay Sahai of FIO. Mr. Sahai, many thanks for joining us. What are exporters telling you at this point in time in terms of revival, in terms of recovery, and more importantly, the sustainability of the recovery? Also, what we asked starting to see is that global growth had picked up. The global recovery was underway, but now we're starting to see a resurgence of COVID cases across Europe and the US. Is that causing consternation at this point in time?
In fact, if you're talking about the global trade, I think the recovery is much faster than what we anticipated, and that is borne by the data by the international agencies. Also, UNCTAD has recently came up with the report which shows that the contraction in the third quarter was just 4.5% as against 19% in the second quarter, and they say that in fourth quarter it will be around 3%. So if you are looking into 2020, the global trade decline is expected to be around 7% as against 13 to 32%, which was forecasted in April. So we are in much better situation than what we anticipated. And coming back to Indian exports, I think we have done remarkably well. We were down by around 60% in the month of April. In September, the recent data shows that we were positive by 5%, and in 22 out of 30 product group, we were positive. So far as we are looking into medium to long term basis, I think there is huge demand, huge inquiries which are coming to the country. We are getting a lot of inquiries from the countries which were totally unknown to us. We are getting more inquiries from the country where anti-China sentiment is on the rise, whether we are talking about the US, Australia, Canada, Japan, South Korea, some of the countries like France, Germany, or Sweden. In fact, those who were talking about the Christmas and New Year's, now they feel that the inventory level will be liquidated very fast and they will be having much better order coming into the way. In fact, in many of the segments, we have done remarkably well, particularly if you're talking about the chemical, plastics, pharmaceuticals, medical and diagnostic equipment, food products across many sectors. Some of the traditional sector exports were under severe pressure, but they are also coming out of it. And in those segments, we are getting demand which is on short-term basis, not a very long-term basis. Normally in textile and leather, we used to have a lead time of around 6 months from order to execution, which has been compressed. But apart from these sectors, I think we have done remarkably well. And I think some of the challenges on the supply side, they are a cause of concern, including the local lockdown at some places, the shortage of manpower. Now we are having container shortage because of the mismatch between imports and exports. The freight has gone up. So I think we have more on the supply side challenges than on the demand side for export.
Okay, so supply side challenges, demand has picked up and has picked up better than anticipated. Global recovery in trade is certainly helping Indian exporters. Mr. Sai, since you spoke about challenges, let me ask you specifically about some of the challenges that have come to our notice. You talked about the mismatch as far as containers are concerned because of the misalignment of imports and exports. We're also hearing about significant delays at ports, and largely we're given to understand it's because of the rollout of the faceless assessment. How much of a concern is that, especially as you anticipate demand picking up? And secondly, the MEIS, because we're given to understand again that the flow through has not happened on the ground. Even the reworked scheme, the flow hasn't happened on the ground. So is that a cause of concern today?
In fact, there are a couple of reasons why there is not adequate availability of container. One is definitely the mismatch. Secondly, I think shipping lines, many of the shipping lines are also not calling at the Indian ports and large vessels are not coming to India. Thirdly, we have seen the pharma agitation in some part of the country and containers have been stuck up. You have also said that, and I agree with you, that faceless assessment which has been rolled in by the customs at some of the places that has also delayed the clearance of the consignment, but on an overall basis, I think faceless assessment has definitely helped the trade, but these are the teething problems with which we have to live it. On the long term, I am sure that faceless assessment is going to be a game changer. So far as MEIS benefit is concerned, we do agree with you that from April onwards, there has been not an actual flow of the MEIS. This is something which FIO and other trade bodies have raised in a meeting with the Honorable Minister, and he has assured that he is working with the Ministry of Finance so the funds are released to the export sector quickly. I do agree that liquidity is definitely a challenge for export sector, and whatever benefit which government can give to the export sector, if they are released in time, they will help us in this time of recovery.
Okay, so that is the hope at this point in time. Let me bring in the view from the MSME world. Anil Bhardwaj of FISME also with us. Mr. Bhardwaj, many thanks for joining us. My colleague Sapna Das reporting today, of course, this is still source-based information, that the government may extend the MSME credit scheme so that the entire 3 lakh crore rupees can in fact be utilized. Can you give me a sense of what business confidence is like at this point in time for the MSME ecosystem? What's the stage of recovery? Are you starting to see people hiring now? Just an update on where things currently stand.
See, clearly the economy is in the restarting mode, but at the same, the present surge in demand is propelled by the pent-up demand and partly because of the momentum in public buying. And on top of it now, we are in the midst of festive season starting from Shad Navratras, and we see, because we know that almost 35 to 40% of the purchases, especially in the white goods sector, and the smaller segment of automobile usually takes place in this season. So we are in, I would say, a very benign phase. And but at the same time, the moot question is going to be whether it would be sustained after, say, February.
Right.
Our experience is that the feedback that we are getting from the ground, that the lower middle class is really hit, especially in the urban centers, because of losses of jobs in travel and tourism, in services sector, particularly the hotel industry, the restaurant business, etc. So very large segment of people are displaced and affected, and that would, I think, drag the growth after February once this momentum of festive season is gone. That's what the feeling we are having. But at the same time, government is trying its best by propelling the growth, maybe after February also, through the public buying. A massive amount of dose of public buying is happening, and that many of the segments in the MSME sector are experiencing.
Okay, so the hope is that this will at least continue to February, if not longer, but the worry is that it may not sustain beyond February. Rashesh, let me come back to you now with that question. How much of this is pent up? How much of this is real demand? Are we making up for what we lost between April to August? And to Anil Bhardwaj's point that services sector, and that continues to be a large part of the economy that is challenged and constrained. Will we see this peter out post the festive season? What are the indicators that you're going to be watching out for?
I think our expectation is that for the next 4 quarters, we cannot take any revival for granted. We, government, RBI, all of us have to constantly do a set of things to make sure this will sustain. So whatever we have done and the pent up demand, if it takes you to a good Q3 and maybe part of Q4, you still have to do a set of things. I think liquidity, interest rate cut, credit transmission, all these are going to be important. As I said earlier, government's ability to put cash in the hands of people, government spending, government capex is going to be an important one. I think a lot of foreign inflows, both in equity markets and credit market, will be important because international rates are low, which is a big positive for India because we can really get some good capital at a low cost but long term and risk bearing capital, because that is what India needs, and that's what's happening with FDI. FDI coming into India. So overall we need all that. We think over the next 4 quarters the virus is going to be around, the impact will get weaker and weaker, but until we get the vaccine and the vaccine is delivered, there will be a little bit of open and shut. If you see a lot of countries around the world, we are seeing open shut. So there is going to be a little bit of disruption ongoing for the next 4 quarters, and we will need counterbalancing measures from the government and RBI to ensure that. So idea is not to take anything for granted, and if you think this current set of measures will take you for next 3-4 months, it's to start planning for another 3-4 months and 3-4 months after that. But I think there has to be a concrete, active, intervention-oriented plan from the RBI and the government of India for the next 4 quarters.
You spoke about the intervention that you would now like to see from the government as far as the next set of stimulus measures are concerned. What's the expectation from the RBI? The governor has made it clear that the RBI is standing ready, standing watch to intervene as and when necessary. We've of course got the next MPC meeting coming up in December. But what's the expectation from the regulator, Rashesh?
See, I think one of the key things that is remaining for RBI to do is to bring the long-term interest rates down and really get credit transmission done. I think liquidity is at the short end, and what we call interest rate transmission is at the short end. The long end, the long-term money, the 3-year, 5-year, 7-year, 10-year money is still fairly expensive and not as easily available. So I would say the two things RBI needs to do, and he's been doing this, the LTRO and TLTROs and all are there to target long-term liquidity availability for the economy. But I would say bringing down long-term rates, bringing down inflationary expectations, and making credit available, not just liquidity. All of us assume that liquidity is equal to credit.
Right.
But we now have a situation where there is a lot of liquidity, but not enough credit available. And we have to convert liquidity into credit for the economic growth to restart.
Ajay Sahai, let me ask you that, as Rashesh was pointing out, enough liquidity in the system but not necessarily credit. Is that a factor that you're faced with as well? And since you do believe the demand is likely to hold and at least is expected to pick up from where it currently is, what is the situation? Are we starting to see people hiring, our exporters provisioning for more capacity, etc.?
On the first issue, we do agree that if you look into last 2 to 3 years, the flow of export credit to export sector has declined. In fact, in 2018-19, that was around 26%, and last year it was around 12%. When in rupee term, our exports went up. So definitely there is mismatch between the requirement of the export sector and the export credit, and RBI has moved proactively that they have brought the entire export sector under the priority sector lending. And government has also provided interest equalization benefit to all the MSME sector and to 416 tariff line. So I think on the credit front, we are much comfortable position now. So far as the issue of these demands is concerned, I feel that the demand is there and people may not have started hiring it because still they do not know how long. That's why I said that if you are talking about the SME sector, they are basically getting the order for a very short duration. They get the order for in the month of, let us say, September for execution in the month of November. They are not getting the order on a long-term basis.
Okay.
So, though of course, I think the employment sector, exports is now providing much better employment in terms of numbers. But if you are looking into the additional absorption of the workforce in the export sector, I think it has not started on a large scale basis, though definitely we are moving into that direction. But I'm sure that as we move along and we are started getting orders on a long-term basis, this sector will be providing much more employment. One of good thing which has happened that a lot of countries have shown interest in investment. Even now we are getting the inquiries from other parts of the country where companies want to invest in Indian medium sector or the small sector. And I think that's a very good sign for exports.
Okay.
I feel that at this point of time, we would also like the government to put little more focus on R&D spending of the company, because I personally feel that if countries' export has to be on a sustained basis, the focus has to be on R&D and innovation. We need to provide some more support to R&D, and we also bring our focus on the standards. Though of course in last 2-3 years we have seen that government is working hard to put focus on the standards. We need to develop standards. We have to apply those standards on the domestic companies, similarly on imports, which will also make it, our export product more export worthy, but will also help us to address the issue of cheap imports happening into the country.
Yes, that certainly is something that has been an ongoing process. Anil Bhardwaj, I'll end by asking you, to the point that Ajay Sahai was making, that there's a lot of inquiries coming in from countries across the world who are looking at mitigating the risks of only dealing with China. Now, what is the real impact of that you're seeing as far as the MSME sector? What kind of implications, benefits do you believe it's likely to have in the next few months?
See, first of all, the similar phenomena is also being experienced by MSMEs who are just catering to the domestic market. They are also not getting long-term orders, and usually the orders are of the range of approximately 1 month or so. So I think that has something to do with because people are not really very sure that what is going to happen in the next quarter. So it's kind of a month-to-month basis in the domestic market, and that's why people are not investing, and that's why the demand that was envisaged in the government of the credit is not as much as perhaps was the case when the scheme was designed on 3 lakh crore. As you know, barely 70% disbursement so far has taken place. Still remaining, and maybe as you right said in the beginning, there is a case for extension also. So yes. Secondly, coming to the point of liquidity, see, in the informal market, in these festive season, the call rate used to go up to 3% per month. But now even 1.5%, half of the rate of interest, the money is available in plenty. And that shows that, the demand for credit is not as much as is used to be in this festive season. So yes, your initial insertion was right.
All right, Anil Bhardwaj, Ajay Sahai, Rashesh, thanks very much for joining us with your take on the recovery, the road to revival, and of course, what we make of the many data points that have emerged and what next needs to be done by government, industry, and the regulator. We are seeing a recovery. The question, though, is will it hold beyond the festive season? The hope is that it will. With that, it is time for us to wrap up this edition of Restarting India. Many thanks for watching. Do stay tuned to CNBC TV18. The news will continue.